Hi, this is Randy Finney with Right Side of the Chart, and this is an afternoon session update for Tuesday, October 8th, 2019. In this video, we'll do an update. It won't be as long as the late session update yesterday. Just go over the charts, what's happened today, some levels to watch. And before I get to the stock market, I want to just go over this chart. I'm working up a post. I'll get this out to you guys with a screenshot of this chart and some written comments there. But what I'm noticing is what I believe to be just another red flag in a whole sea of red flags. You can add it to a lot of distortions. Bottom line, it's just tremendous distortions that the Fed has caused. Unintended consequences with the excessive and extreme easy money policies over the last. It's been over a decade now, and no end in sight too. And so a lot of smarter people I listen to and read, and what I believe is there's always unintended consequences, or quite often, for things. This is a grand experiment. It's never been done anywhere close to this scale. It's not just the Fed, all global central banks, and the Fed really almost backed into it. No way out of it now. Just like Japan with their lost decade, you can do a Google search on the lost decade Japan. Learn a little bit about their what their similar path they took 20 something years ago. All right, what I wanted to talk about is just keep it quick, is the what I believe to be a very dangerous disconnect between the energy sector right now, all year actually, and the junk bond market. Just real quick, if you're not familiar with what junk bonds are bonds that have they're corporate bonds that have a below investment grade rating. These are companies that are on the edge. As long as things are going okay, they're making their payments, but it's like, think of it this way. Think of the person that goes out and gets a car loan at 15% has a credit score of 500, Beacon score of whatever, bad. I think that's very bad. 500, I know 800 is good, anything above that. And they're the kind of person that, chances are, economy takes a downturn, they're going to stop making payments, or they lose their job, they stop making payments on the car gets repossessed. So that's the same kind of thing here. You have corporations that are not fiscally fit, meaning they're as long as the cash is coming in, you're going to get paid. Otherwise, if the company takes a blip downwards, they're going to stop. They're going to default on the payment on the bonds. You may or may not get back some of your principal on these. Now, the flip side is they pay good rates, so what's happened here is we've had this just a tremendous disconnect. So let me just start out with what we're looking at here. Okay, you can see up in the corner, here's this, tells you what we're looking at. JNK, two main ETFs out there, JNK and HYG. They both hold the same thing. They hold junk bonds. Junk bonds represent, last numbers I had earlier in the year was about 15%. It's a big weighting in the energy sector. And of those energy stocks, it's not your Exxon Mobil or BP. Those are the main holdings in XLE. So if you're wondering why I used XES and XOP, this is XES is the energy, that's the services sector, and the XOP is exploration and production. And that's where you have, in these two sectors, a lot of those shaky companies that are just on the edge. And if you've traded stocks for a while, you've seen a lot of companies go to the wayside. Chapter 11 bankruptcy, they're gone. A lot of energy stocks with this glut in oil that we've had for the past decade or so. All right, so therefore I use those two. Black is JNK, the blue is XEX, and the red is XOP. Now, when you look at these charts, this is why I like to do the videos. I can explain this a little bit better. When you look at a comparison, don't look at the differential, meaning the distance between the lines. That's irrelevant. Look at because they're priced different. They start out on different prices, so they're not going to overlap completely. And bonds are not going to move up and down as much as energy stocks. Energy stocks, when they rally, they go up a whole lot more in percentage terms, and when they fall, they drop a whole lot more than junk bonds. So what you want to look at is just the general trend or direction each one's moving. And I can just tell you, you can freeze it and look at it yourself. This is a nearly perfectly correlated, these assets are nearly perfectly correlated, meaning when they go up and down at the same time. And what you look for, or what I look for in any two assets that have a high correlation, and again, It's very simple, by the way, guys. This isn't like the gold US dollar thing where gold goes up. It's inversely correlated to the dollar because the dollar drops in value, and therefore takes more dollars to buy an ounce of gold. That's why the dollar and gold have. The reason these two have a positive correlation is because if the energy stocks are doing well, oil prices are rising, profits are up in the energy sector, and guess what? The chance of them defaulting is a whole lot lower, right? And so that's why you have that. Now you can see energy prices just collapsing starting about 2014, and you can see junk bonds went lockstep down with them. Bottomed at the same time, topped at the same time. Therefore, you have that, like I said, an unmistakable correlation. So where am I going with this? We've had two disconnects in recent years. We had one right here. All of a sudden, at this point, I'm going to box it right there, we started to see something different happen. We started to see junk bonds continuing higher, and the energy stocks falling. And that is not normal. And that what happens there is the risk of those junk bonds is going up a lot more. The risk is increasing if these energy stocks are falling. Things aren't going well. Oil prices were falling, so the sector was falling. What happened there is they had first a mean reversion. I should have colored these arrows a little darker. Here, I'll do that color. Make this arrow black here. All right, so this was a mean reversion, meaning that the energy stocks caught up. They rallied, but at the same time, because junk bonds had gotten ahead of themselves, meaning too much risk was not priced in, and so junk bonds started falling. And that was the mean reversion where they kind of came back together. However, if you look at this, from that peak, once that disconnect started, junk bonds had the second biggest drop in over a decade. They fell 12% right there. You can see my pop-up box to the left at the bottom, 11.67%. That is the one of the biggest drops, if not the second biggest drop besides this one, in over a decade. All right, and that was, again, because pricing got out of whack there. What happens here is, I'm making these explanations. I used to be a financial advisor for many years, aka stockbroker. Before that, I was a business major. So I know about these things. I know how much risk is taken there. I'm certain, because I used to sell these investments to people, that a lot of mom and pops investors don't know the risk that they're taking in junk bonds. And the thing is, when everything's chugging along great, they're fine. They're paying you a much higher rate than you're getting on investment grade bonds, than in high quality stocks, the dividends on high quality stocks even, but yet you're taking a lot of risks that you're not aware of, and they can drop pretty quick. And the yield on this, I'd have to check. It's, I'm sure it's going to be under 5% now or somewhere in there. But if you drop, in this case, it was only a year, less than a year and a half, about 1.4 years, and they dropped 12%. And so you wiped out. Whoever bought right here, not aware of that disconnect, they lost 12% over the next 1.4 years. Something to this point they haven't even recovered. You're not going to make that back in dividends. You had a little bit kickback in capital appreciation, so they're back okay. They're right now, those people are good. But if you bought back here, and this, by the way, I'm measuring the drop on junk bonds from the top, 24%. This is during an economic expansion. They dropped 24%. Mark my words. Wait until the next recession, wait until the next bear market, and you will see a much larger drop than 24%. So it's all about risk reward, right? You always hear that with stocks. The trades I make, the trades most people make, you take your risk and you weigh that against a potential reward. So, people chasing 4 or 5, whatever it is, 6% yield on junk bonds, don't realize, especially if they just tuck it away, or it's in their 401k or their IRA account maybe, and they're not aware, easily 50% of the junk bond, this ETF will probably be wiped out, if not more, come the next recession. And it may be underway. Look, these guys topped back in mid 2014, and they're still. So there's a good example too. If I want to play with the numbers right there, they're still down 14-15% from that high. This is where most people bought them years ago, and they haven't made, since they bought this point, they haven't even made enough in interest to make up for that, the capital loss right now. All right, so let me just wrap up here, and we'll move on to the stock market. So what I pointed out here was a relatively small disconnect, followed by a correction, about a 15% drop in junk bonds, and you're using JNK here as a proxy. It doesn't even measure up to this drop now, and that's why I'm doing this video. I'm talking about this now before it happens. Energy stocks have been plummeting. They've been in a bear market. The energy sector has been in a bear market for years as well. Again, it's not coincidence. Since junk bonds topped, again, they're right there together. But what I'm concerned about right now, what I'm trying to highlight here, is this huge disconnect that started at the beginning of the year. Everybody thought after that rally started at the end of December 24th, because the Fed flipped from being hawkish back here, which exacerbated that move down, to being dovish, meaning their next move would be to the downside on rates instead of upside. And so it was risk on. Risk on means everything's okay, buy stocks, you're not going to get hurt, the economy's going up, and so far that's worked well for those that did. And buy junk bonds, don't worry about it, there's no recession in sight. Hey, maybe that's going to be the case, but all I can tell you is mean reversions come after this. You can see what's happened. This is, again, the beginning of the year here. Junk bonds have rallied, and they're not far off those highs. Energy stocks have fallen and continue to plunge. Yes, a mean reversion can come where you have a rise in energy stocks, but you're still going to have to close this gap, because what this is, plain and simply, the way I view this, is a gross disconnect between fundamentals. Fundamentals meaning these are what they hold. The risk now, there's no way that the risk on these energy stocks, the risk of them defaulting on those bonds, is any less than it was back when they were right here. Because that's where JNK was trading, right here, when XES and XOP were in this range. Now they're down here, yet junk bonds are still priced at the same risk premium they were back here. Something's amiss, and that's why I wanted to point that out. How do you capitalize on it? Well, I'm not a big fan of shorting bond funds because you have to pay the dividend when you are short. But then again, if you're going to cover the dividend, if you expect a drop of 20% or more in a year and you're talking a 5% dividend, whatever it is, that might be worth it to you. So I'll throw that idea out there. I don't have a hard sell signal on this right now. It's just a development I'm watching. And there is an ETF that actually shorts junk bonds for you, so you buy it and then you're not, you don't have to have a margin account. In other words, you can't short JNK unless you have a margin account. So you can't short it inside of an IRA, only on a margin brokerage account. Okay, here's your trade ideas. I've shared it here before. Actually, I have the chart already marked up, targets for you, and all that good stuff. And what stands out to me, it's just it confirms. So what I just spent 12 minutes talking on is pure fundamental analysis. Again, that's my original background before I found the magic of technical analysis, which is using charts to predict where security goes. That's where my background lied in fundamental analysis. They don't at least, but not when I went to college. They didn't teach you anything about reading charts and looking at chart patterns and things like that. It was all fundamentals, balance sheets, debt to income ratios, and all that good stuff. But this is the technicals right here, and you can see you have a downtrend line. You have divergence that has been building. We had a divergent low right there. We did rally quite a bit in this, again, shorts high yield bonds, and it's coming up to this downtrend line. So if you get a solid breakout here, I will say this, I'd want to confirm any breakout in this with the charts on JNK and HYG. I can also tell you this, you can blindfold me, not let me look at the charts HYG and JNK, and I can trade those simply going off the stock market. Because if and when the stock market, we get some solid sell signals, everything I've been talking about for weeks and months now, the 40-week moving average is taken out. Again, if we have another thrust to new high in the market, we'll probably see junk bonds rally, which means this ETF goes down, so the breakout might be deferred. Could be weeks, months. We'll see. So again, when the stock market breaks down, that's when this will rally, just like it did back here. Remember the fourth quarter sell-off. There's no mistaking that. You're not going to see junk bonds hold up or rally if the stock market drops 10% or more, especially impulsive selling. So again, we'll align these trades. And I can say this too, even though it is a completely different asset class, you're checking the box for asset allocation. You're not, unlike other bonds, they tend to trade much more in line with the stock market because of all the reasons I mentioned before. So where you have treasury bonds, TLT, things like that, municipal bonds, investment grade corporate bonds, those tend to have an inverse relationship, and those tend to cushion your portfolio. When stocks fall, those bonds tend to rise. Not these. So I just want to point that out there. So you don't, in other words, a 50% short your portfolio, 50% the S&P 500, and another 30, 20, 30, 40, 50, whatever it is in this, you're either going to make money on both trades or lose money on both. Is, I guess, the easiest way to say it for the most part. And that's strategic positioning. I'm sorry. Yes, strategic, longer term trend positioning, not tactical. There's always, these disconnects like I showed you earlier. And you can take advantage of those with quick tactical trades, swing trades, get in, get out. But as far as positioning for the next trend, like I said, the breakout and whether or not, or when I should say, these targets are hit will most likely depend on when the stock market breaks down, and that move up there to potentially this fourth target would probably coincide with those longer term swing targets I'm talking about on the market to the downside. Okay, we'll get away from bonds. Before we do, by the way, and the only reason, if you said, well, Randy, if it's, the correlated trade, why not just stick with stocks? Well, number one, bonds are a little less volatile. And also, because of that disconnect I just showed you, there's going to be a reversion. So you could see a pretty swift move down in junk bonds that is more than what you might normally get if just the stock market was falling and junk bonds weren't mispriced, as I believe they are right now. In other words, again, I think that they're not pricing in the amount of risk based on the fact the energy stocks have been plummeting and continue to fall. All right, what's going on today? Let's just make it quick. We gapped down. Yesterday's covered. We had the bearish engulfing candles. I mentioned that would be, you could take a short there. You had a 60-minute bearish engulfing candlestick. It did end up finalizing. All you have to do is engulf the body of the previous candle. In this case, we engulfed 1, 2, 3, 3 previous candles. We were followed up at the close with another red confirming candle. So there was your, you short there. That was your confirming candle, and then we gapped down. And so, had you shorted at the close of that bearish engulfing candle, so far at the lows, that would have been good for about a 1.64. Look, active trading stuff, but also, as I said, if you're a swing trader, maybe that would have been an entry that you made if you're looking to get into or add to some swing shorts, and you have your stop just above that candle at this point, maybe a little bit above that gap. We'll see. Let's take a look at what's happened today. Other than that, we gapped down, and it was interesting because look where we gapped down. And I did post these charts in the trading room today, and some trading ops there, day trading, mostly active trading stuff. But look where we gapped down. Almost exactly, if not exactly, where on Friday's gap. There's Friday's gap right there. We talked about that. Gaps are very significant. And look, by coincidence or not, that gap lined exactly with Wednesday's gap. So we have gaps are levels, and I've said this before, when volatility spikes, technical analysis shines, because that's what traders flock to. Even if their primary investing style might involve fundamentals, when things start going wacky, that's when the traders step in and they trade off these levels. So you can see you had a gap there, an identical gap, and then today, although the gap is here, we opened right down below that gap. Tried to recover it real quick, couldn't do it. So this morning I posted an active, day trading op in the trading room. If you weren't already short or from yesterday, or if you wanted to add to it, let me grab my arrow tool down here, color that again, and I said, natural target would be to shoot down here to the that 185.90 level. It's that yellow line I've had on this chart for a long time, called a gap city. It's nice support. So we hit that level, brief overshoot, and then at that point, that's where it said, cover, be an objective place to cover, and that's where I reversed to go long for a bounce, covered my shorts and went long for a bounce up to the top, shorted. That's the objective shorting level at the top of the trading zone. And the reason I'm doing this video, I said, look, if we get in the zone, into the gap, they may want to try to backfill it, and that still may be the case. Gaps once entered are often backfilled. So as I'm doing this video, that was a momentum fueled overshoot. Doesn't really mean much. You whip above, you whipped above here. You can see these, you whipped above it again. Now we're in the gap. I will tell you, the logical target right now would be a backfill at the top of the gap, maybe come in at this trend line, but I'm leaning towards them not being able to fill that gap. I'm leaning towards this being a little fake out move, and would go down today. I'm still short. I'm still holding on my shorts. I'm giving them a little bit of room because you have up here the top of the gap and the downtrend line. So percentage wise, that's only about 0.5%. And so day trade positions, I've already been in and out. I'm talking swing positions, quasi swing positions. I talk about having long-term accounts. Those I'm not even touching right now. And then in my active trading account, I went home short last night because of this. So, and then adding today was just once the regular session opens, more liquidity. And then, I'll micromanage, add on some extra contracts, NQ or whatever it is I'm trading. But let's watch this. That's what I wanted to get to here, is just tell you that should we move much higher, then that's the next resistance level, the top of the gap there. And the next support, if broken, would be that 185.90 level. We already undercut it a little bit, so if you want to play it safe, this would be your next sell signal. And I think if this happens, here's why I wanted to do the video. I believe if we break that, not only we're going down to the next support here, which is about 185.12 right there. No, this is a more, that is support. I should turn that line on now, make it a little brighter so you can see it. That is support, but same thing I was saying back here, even though it didn't happen. I suspected that since we had already tested the bottom of this trading range several times back in August, I figured once we got down there, I was expecting a bounce. Remember, the day those flags broke down, I was expecting a reverse off 181.46, and we fell a little bit shy of that. And I had a comparable level, I think it was on NQ. But I was expecting, and still am, that if we get down there again, close to it, we're probably going to take it out. I say that for many reasons, including things that I'm seeing on the daily chart. So again, without getting too in depth in this video, that's where I think we're going. But if the bulls can recover this gap and then some, near term, we might go higher. Why? You have the gap there. If they take that gap back, that's bullish. The sellers should step in at the top of the gap. They also have right now, you can see they've crossed this PPO over. I mentioned it yesterday, it was only slightly above, but it's starting to turn back up now at the zero line. So this is a pretty key area I'm watching. If the bulls can rally it much more, then they take that gap out, they're going to try to make a run at this high. And as I told you before, we are in a downtrend. So far, we have a nice clean series of lower highs and lower lows. And so the ideal thing to keep this downtrend intact would be to reverse before we take out that high from yesterday right there. So that's it. And if we take it out, it's going to turn this trend and keep this trend indicator in bullish territory right now, and then it's going to open the door to take out this high, and then that should likely embolden the bulls and maybe send us up to that marginal new high, which still, from where we're at now, it changes every day when we go up or down, but at this point maybe 6-7% above where we're at now, or less. But we'll see. This stuff changes day by day, so anything I'm leaning towards can and will change tomorrow depending on what happens here on the charts. But to keep it very simple, watch the top of this gap, what happens here, right here, today's gap, and watch today's lows. That should quite likely determine the next probably 3 to 5% plus in the market, quite possibly, I should say. You hear a little hesitation in my voice because it's not always that simple, but that is kind of the way it's looking right now. And then on SPY now, remember I just spent a lot of time on QQQ. Well, here's one reason why I think QQQ might not be able to fill the gap. So you have the S&P 500 traders, they're watching this gap right here. There's the gap from Wednesday right there, defined by these two lines. And they've entered today's gap from below, but this is still a significant level, and there's a lot of gaps back there too. So they might step in and sell it right about here. And I'm trying to make that line even. I had it parallel, or level I should say. There it is. So let's watch SPY. SPY gets much above there. It's going to be in the gap as well, and then it's going to run for a gap backfill. So you want to watch this as well. What happens if they do backfill the gap? Do the sellers step in? Do we head back down? Is it just a minor reaction there and then a move back up? And if so, here's a potential downtrend line. I say potential, it's not yet been validated. We only have 1-2 reactions on that trend line. Maybe I could move it down right here, and we'll look at that as well, and just say that this one popped it slightly above. So those are the levels to watch. And again, at the risk of oversimplifying it, bullish if we start to get up here. Let me use my circle tool. Bullish up here could open the door for more upside, especially you see a lot of reactions right here. You take out 298, that should open the door for a run back at those highs, another test, and maybe a breakout of those highs. Whereas if we fail anywhere from where we are right now to here, we move down below. Watch for this trend line as support right here. Pretty important uptrend line in SPY. And again, on QQQ, I'm watching this horizontal line and this potential uptrend line here. So that's it, guys. Choppy stuff. If you are not a very active trader, don't get lost in this grind. It'll tear you to pieces. Up, down, up, down, up, down, little near-term downtrend, near-term uptrend. But the bottom line, this market's gone nowhere for months now. That's when you step back, look at the daily chart, and say, what do you do with this? Bulls aren't making money for the last, if I'm talking anybody positioned like in a 401k, long-term, not active traders. Active traders can make a lot of money in this kind of market, whereas less active traders, you want to sit back and see what happens here. We've already broken down. We're back testing. Do we get rejected? That's the way I'm still leaning for now. And so I spent all that time on the 60-minute charts because that will has a potential to get us back above these trend lines and negate these more powerful sell signals on the daily charts. But should we turn down here on or around those gaps I just mentioned, this scenario could play out, and then that opens a door for a much larger move down. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.